Let's talk about comfort letters and underwriters. This is just kind of a new concept, unrelated to supplementary information and compliance reporting. It's related in a way, as you'll see, but it's just kind of, think of it, we're starting off into another big, beautiful world. In this case, talking about this concept, we've got comfort letters. These underwriters are people, and comfort letters are, we'll see what those are, they're letters. This section is going to address the auditor's responsibility when engaged to issue letters, also known as comfort letters, to requesting parties in connection with a non-issuer's entity's financial statements included in registration statements filed with the SEC or included in other securities offerings. Now, what is this? When a company goes public, underwriters, those who, and we'll see slides describing this, but I'm just giving you a brief overview. Those who facilitate the company going public or facilitate these transactions usually like to see comfort letters, which are essentially a light version of an audit. So it's kind of like, instead of getting a full-on audit, it's a letter that gives you comfort that the financial statements are looking good. Now, this is, maybe they're required to get an audit as well. That's not talking about, this is instead of an audit. This is just kind of like, whereas with compliance, right, we see that you may have had an audit initially, and then you get a compliance engagement on top of that. So too here, a company's likely going to have to get audited before it goes public. But then these underwriters, because they're the ones who are going to facilitate the company going public and then sell those shares of stock to the public or to firms or anything like that, they want an additional layer of comfort over that audit, specifically maybe towards them, letting them know that, hey, this company is legitimate, they've got legitimate revenues, and we can actually justifiably and ethically sell shares of this company to whoever wants to buy it. Diving in here, we're going to actually talk more about what an underwriter is, those criteria for it. I'm actually going to look at the second paragraph. I mean, this is pulled directly from the AICPA's authoritative literature, and I want to just start with this. Just think about it. We are here, it's the 1933 Securities Act, and we're kind of mid-Great Depression here, so we're creating legislation. This is just something that was added in that legislation. Here, except when the context otherwise requires, the word underwriter, as used in this section, it's going to refer to the managing or lead underwriter. It's going to refer to that one person who's in charge, who typically negotiates the underwriting agreement or purchase agreement for a group of underwriters whose exact composition is not determined until shortly before a securities offering becomes effective. Again, these are the groups of people, and in this case, the lead person, who's facilitating a company going public and then going to sell the shares to the general public or to certain groups, maybe private investors, something like that. Now, going back here, an underwriter is any person who has purchased from an issuer with a view to or offers or sells for an issuer in connection with. And again, kind of just briefly looking over this, it's obviously very wordy. If you're distributing securities from that issuer, right, they're going public, participates or has a direct or indirect participation in the undertaking, if you're involved in that. So basically what this paragraph is saying is it's someone who is going to be involved in that. But then when we actually refer to the underwriter, it's that head person. Just a brief, again, overview here. This paragraph is talking about someone who's involved with taking the company public. And then generally when we talk about underwriters, it's going to be the person who is in charge of the whole ordeal, in charge of their team. All right, now taking from the AICPA what they talk about comfort letters and securities offerings. Auditor services include audits or reviews of financial statements included in security offerings. In connection with the securities offerings, auditors are often requested to issue comfort letters to certain requesting parties. Now, they're not required to accept an engagement to issue a comfort letter. It's just something on top to sweeten the deal. Extra work, you obviously get paid for it. And like I said, this is going to be something where the underwriter wants a little bit more assurance over what they're doing. Who doesn't want more assurance? So what's the cost? It's just, you got to pay the auditor to kind of do additional work. Obviously, we're going to talk a little bit more about what that work looks like. The securities offering, so think IPO or initial public offering. It's a type of financial transaction in which a company offers securities for sale to investors. So if I've got a small startup and then it explodes, it goes really big. I want to just kind of get out of there, right? I want to sell my company off to investors, hire someone to run the company. That is going to be, likely through an IPO. It's, Uber, right? It was Uber, Lyft, all of these rideshare startups, Grubhub, all of these tech company startups. They were all smaller companies. They had a team working on it. And then how do you really cash out there? Well, you sell the company to the general public. They're going to pay a hefty premium because it sounds like a hot, flashy startup. And That's the way the business world works. Securities may be in the form of stocks, bonds, or other types of investment instruments. We talk a lot about stocks, but you can also be an underwriter and sell someone's sell someone's bonds or debt for them. If a company, whether they're public or not, they want to raise money using debt. Those debt securities can make them a lot more money if they're publicly traded. And as such, these investment banks or financial institutions can help facilitate the transaction and get those bonds listed on the open market. A little bit more here about underwriters in connection with those security offerings. The service of providing letters for underwriters developed following the passing of that 1933 Act that provides that underwriters, among others, could be liable if any part of a registration statement contains material omissions or misstatements. We see here, it's not just for additional comfort, it's because, well, it is for additional comfort, because if those underwriters, it kind of put more responsibility on them, saying, hey, you can't just fraudulently or haphazardly distribute these securities to the general public, try to make commission on it. No, if something goes wrong, it's kind of like Sarbanes-Oxley, where now if something goes wrong in the financial statements, the CEO, the CFO, management are held accountable, whereas priorly they weren't. So to here, just think back, we're thinking the roaring 20s, everyone's investing in the stock market, it's the hot thing to do. And within that, there's a lot of underwriters, a lot of people just selling stocks, maybe without doing due diligence, selling stocks to the general public. Here, there is going to be more accountability for those individuals. And as such, because there's more accountability, more responsibility, they want to hire these auditors to give them comfort letters, to give them more comfort that what they are selling is actually a solid company. This 1933 Act also provides for an affirmative defense for underwriters if it can be demonstrated that after a reasonable investigation, the underwriter has reasonable grounds to believe that there's no material omissions. So what it's saying here is if we do get a comfort letter and we essentially did our due diligence, we did enough work. I mean, there's only so much work you can do. You're not going to spend every waking hour of your day analyzing a company. But if you did get a comfort letter and you have reasonable grounds to believe that there were no issues, then it covers your butt. You're safe. An auditor issuing a comfort letter is one of the number of procedures that may be used to establish that an underwriter has conducted a reasonable investigation. Kind of, again, covers that liability. Consequently, underwriters may request auditors to assist them in developing a record of reasonable investigation. So saying, hey, auditor, help me if I get under attack from the SEC or any legal authority, please help me. I want to have a paper trail to make sure that they can see that I did my due diligence. Essentially, before the underwriter sells the securities to investors for a percentage of commission, the underwriter wants to do their due diligence by having an audit or review done on the offered company's stock. What are some subjects that we're going to cover here in the comfort letter? Subjects that may be covered in this letter include the independence of the auditor. We're going to obviously discuss that. Whether the audited financial statements included in the securities offering comply regarding form in all material respects with the applicable accounting requirements of the 1933 Act and the related rules and regulations adopted by the SEC. That's what we're going to say. So, well, again, the company's going public and there are audited financial statements. Cool. Think about it like bonds. Even if the company's doing bonds and they're not trying to sell stock, you don't want to buy bonds from a company that is on the verge of bankruptcy. Maybe that's part of your complex strategy, but generally speaking, an investor doesn't want to buy anything from a company that may just be about to go bankrupt. So we have audited financial statements, and then on top of that, this comfort letter is going to basically say, hey, this audit is accurate. It's just another layer of protection. It may include unaudited financial statements, condensed interim financial information. Kind of just, take a look here. It may include just any other financial information that is going to help and give context. May include tables, statistics, and other information included in the securities offering. If we're issuing a comfort letter about these items, we might want to include those actual items here. So we might include these forecasts, these discussion and analysis pieces, anything like that may be included. We've also seen this concept of negative assurance, and this is going to include negative assurance about whether certain non-financial statement information included in the securities offering complies regarding form in all respects, material, with let's just say the particular regulations. Don't worry about the specifics, whatever SK means. Again, pulling this directly from the authoritative literature, thought these were the most important and beneficial points for you. We've talked about it a little bit, but what are the objectives of issuing a comfort letter for a securities offering? Well, the objectives of the auditor when engaged to issue this letter, we want to address appropriately the acceptance of the engagement and the scope of services, So first, what are the objectives? Is just make sure you accept a beneficial and healthy engagement. The next, issue a letter with the appropriate form and content. Just do your job. Give an appropriate report. Comfort letters a little bit more. Take a stretch, get some coffee, have a little energy drink, whatever you need to do. Get some food, make sure you're eating, taking care of that body. We got a few more slides before we are calling it a day here. An audit provides an opinion on financial statements, while a comfort letter provides a positive assurance that there are no material modifications that should be made to the financial statements in order for them to be in compliance with GAAP. Comfort letters are used to provide assurances to third parties regarding the financial stability or solvency of a company. They're often used in situations where a company is seeking financing from a lender or investor. How do you seek financing? Through debt and equity. As such, that's why we're talking about securities offerings. And the third party wants reassurance that the company will be able to repay the debt. You've got public company, we've got Uber going public, and whether they're trying to sell their stock or sell bonds on the open market. You've got all these investors over here, and they'll just be little circles. These investors want to buy whatever Uber has to sell, and it's got to go through this broker, right? This underwriter, and then it's going to go to all of the investors. Now, the investors, and then also obviously to cover his or her own butt, the underwriter wants this comfort letter. This comfort letter is going to sit here and make sure it's kind of like a filter, right? It's not going to let any garbage companies get through, and it's going to provide assurance that what they're seeing is true. Now, it's not going to particularly say that the company's doing well or that this is a good investment. That's up for you to decide. But it's going to say that, okay, the company's financially stable or solvent through reaffirming the financial statements. A company would want a comfort letter instead of an audit when the company is not required to have an audit, and that kind of applies in general to any engagement. A company would want a lesser engagement than an audit when the audit is not required. Audits are backbreaking and time-consuming, and if you've worked in an audit, you know. So that statement kind of applies in general, but wants to provide financial statements to its lenders or investors that have been reviewed by an independent accountant, noting that we do want independence here. Let's talk about accepting an engagement to issue a comfort letter. Well, the auditor should determine whether to accept an engagement for this comfort letter. The auditor is neither required to accept the engagement nor required to provide comfort on every matter requested when accepting an engagement to issue a comfort letter. Now, it's just kind of like, why are we specifically mentioning that we're not required to do any of this? The auditor could feel obligated. It's also want it to be known that this is the auditor choosing to do this. It's essentially assigning responsibility, assigning the context to which this letter is provided to the investors, to the creditors, to anyone who wants to know. The auditor should sign a comfort letter and provide or address it in connection with financial statements included in a securities offering only to these specific parties. So we're going to see it is a little restricted in use. And, in auditor, and that's the thing, I don't really think an auditor would not know this, but it's kind of also, we want the auditor to know that even though you did the financial statements, you're not required to then go and do a comfort letter. So it's just kind of like, again, like as an auditor, I would think you would know that, but hey, it's got to be written somewhere. The auditor should request the requesting party to provide either a written opinion from external legal counsel that the requesting party has a statutory due diligence defense. Now, this is kind of covering the auditor's butt. This is the auditor saying, hey, requesting party, which is usually going to be the underwriter, we want to make sure that you have an actual defense here. You've done your due diligence. So it's kind of covering us. We're covering our butts as the auditor doing the comfort letter. And we also want a representation letter that's addressed to us as the auditor and contains the statement, the review process applied to the information relating to the issuer of the securities is, or will be, substantially consistent with the due diligence process that we would perform if the securities offering were being registered pursuant to the Securities Act of 1933. We are knowledgeable with respect to that due diligence process, essentially saying the underwriter has to do their own due diligence as well. And it's going to be signed by the requesting party. This is covering the auditor as well, because it's saying that the underwriter has done their own due diligence, right? That they have legal grounds for what they're trying to do here. They're not trying to get a comfort letter inappropriately, is kind of what I'll summarize all of that up with. Lastly here, let's just recap it all and just a couple points. Comfort letters, they're provided from a CPA to an underwriter or other requesting parties. They are restricted use in nature. They include representations on each party's responsibility, just like any good representation letter or agreement. Now, let's talk about the concept of positive assurance and negative assurance. Now, as we've discussed, negative assurance is usually a statement by an auditor that nothing has come to their attention to suggest that the financial statements are not presented. So it's kind of like that negative. Think of it like, if you say double negative, nothing has come to our attention that suggests they're not in accordance. Whereas positive assurance, reasonable assurance says, okay, we provide reasonable assurance that they actually are totally good to go. We have, with comfort letters, we have two types of assurances that apply to different things. We have positive assurance on that the CPA is independent, and we have positive assurance on compliance on the form of the financial statements if they are audited. Now, let's think about that for a second, because we did mention both positive and negative assurance when it came to comfort letters. What we do have positive assurance on is if these financial statements were audited, because as we saw, generally, you'll have comfort letters on top of audited financial statements. And so if they were audited, well, that's positive assurance. Now, if you have this comfort letter in related to unaudited financial statements, you're going to have negative assurance. And if it's pro forma financial statements, because those pro forma financial statements are essentially trying to be a forecast, a prediction, a possibility of what the financial statements may look like in the future. That's it. I hope you've had a good time here. I've got a nice summary for you. We'll recap it all up here and move along with our day. Keep powering through, study up, get some extra questions in, and stay with it.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.